first idea is Fairfax Financial FFH.
So this is, let's call it our higher for longer trade. If you look at Fairfax over the last year, the insurance markets are hardening, so they're getting sales growth, which is great. And then on top of that, as an insurance company, they're collecting the premiums, and then they have the float to invest. And they're quite short duration on their float, so they're investing in money market funds out to sort of 2, 3, 4, 5 years at the highest part of the interest rate curve. So they're doing exceptionally well from an interest income perspective. If you look at run rate from last quarter, it was about 1.4 billion. Now they're about 2 billion. So we expect as interest rates, if they stay higher for longer, then they'll continue to generate that interest income, and it's something that'll be very nice to have in the portfolio as kind of an offset to these higher rates. In the insurance space, you have your Berkshires, you have your Progressives, you have your Markells, and then there's kind of Fairfax. And they've had a history of doing some things that are, less optimal, we'll say, for the market in terms of some of the equity positions that they've taken. So they're trading at sort of this historical price to book discount. And I think over the next bit, that can close. And that's really an opportunity for the stock. Like it's had a great year already, but I think there's opportunity over the next couple of years for that stock to continue to do well. They'll remain short duration, and they're really going to benefit from these higher interest rates.
Yeah, over the years, Fairfax backed CanWest, I believe.
Yes.
And BlackBerry, they put money in.
There's some doozies in the portfolio, yeah. And then there was a period of time when they had this hedge against the market. So they were predicting the stock market was going to crash, and it went higher and higher and higher and higher. So I think that's, a lot of people, when you say Fairfax, they kind of, they make that face and they say, oh, really? Because they have memories of this. But the Fairfax today seems to be more disciplined. They're still absolutely value investors. So they're looking for the beaten down equities. They're holding those in the portfolio. But I think the interest income is going to overpower things going forward.
Okay. We have TC Energy as an idea. This one's been beaten up.
Yes. Yeah, another name that's really come down. So, pre-COVID, they were a $60 stock. In that first March, April, as COVID was hitting, I think they were down to $40 when oil was crashing. And now they're kind of around 50. Dividend yield is over 7.5%. So nice to have into the portfolio. If you look at the business, again, they're sort of reevaluating their strategy. They've sold us off the Columbia gas side of the business, raised about $5 billion, used that to pay down debt. Mechanical completion of the Coastal GasLink is there, so they're going to be able to move gas across BC into Kitimat and send that out to the Pacific Ocean and the Asia-Pac countries. One of the interesting things, and I'm going to read this because I think it's important, 89% of their debt is fixed rate, and the average maturity on that debt is about 18 years. So they've done a very good job, and kudos to the CFO, that they've done a very good job of insulating themselves from the impact of these higher interest rates.
Okay. That's interesting. Yeah. So you don't expect their interest bill to pick up
It will
too
tick
much.
up, yes, but they've done a good job in insulating themselves. So if we are higher for longer, then they're still going to be okay.
They don't have to keep rolling over debt at high prices.
It's quite expensive to do so these days.
Okay. Your last idea is a medical play, Danaher.
Yep. So Danaher. How do we describe Danaher? They're sort of in everything and things that you wouldn't ever want to be exposed to. So in hospitals, they're in drug discovery, they're in a whole bunch of different things from medical device and medical consumable perspective. They had a significant run through COVID. And what happened was a lot of their customers, they ordered too much, because it was unclear what was happening with the supply chain. So they went and they said, normally I'll get 100 units, I need 200 units. So there was a real bump in sales, a bump in earnings, and in particular from COVID, sort of a one-time lift, 2020, 21, 22. They now have some harder comparables because the COVID spending's come off. And there was a significant amount of revenue that was going to China. That's come off as well. It's still there, but there's less than there was before. So we're really dealing with like a hard 23 versus 22. When we look at it, though, when we look at 24 and we look at 25 and 26, a lot of the Danaher products have been spec'd in. So in other words, if you're manufacturing a drug, if you're Novo Nordisk or any of these companies, and you create a drug, it's not just the compounds that go in, but it's the machines that you use to make the compounds, it's the cell lines. There's a whole bunch of processes that are involved in that patent. And if you try to switch anything out of that patent, you have to go back to the FDA and you have to start again. So as we continue down the road of biologics, which is a huge growing part in the pharma industry, there's going to be more and more demand for Danaher products. So I think 23 is going to be a hard year, but I could see strong 24 and then 25 and onward. They're really going to be sort of the fulcrum position in drug discovery and then drug manufacture.
That's interesting. And sorry, remind us, how are they so important for drug discovery, though?
So from a discovery perspective, a lot of testing has to happen. So I put 10 compounds in an assay and I blot across to see, is this reacting the way that I want to with this antibody or whatever it may be. So they're heavily involved in that. And they've done, part of why Danaher is such a great company is because they actually started as a real estate company back in the 70s, and they've just continued to evolve over time. So in the past 2 months, they've spun off an environmental group called Veralto, and now they're a pure play life science company for the first time ever. So they're very focused on life science. They see that's where the biggest opportunity is going forward, and they're not afraid to go out and acquire. So they bought the assets of GE Healthcare a couple of years ago, and they always have their eye on different items out in the market.
Okay, thank you very much indeed. First idea here, National Bank.
We've been a fan of National Bank for a long time, and right now it has some compelling reasons why one should buy it. First of all, the house prices in Quebec never did what they did in Toronto or Vancouver, even in Montreal. So the bank just doesn't have the exposure to renewals at higher mortgage rates that some of the other banks do. Secondly, right now the yield is tremendous and the multiple on earnings is low. I will say that they're a little bit exposed on their proprietary trading, as all the banks are, but it's got a quiver of services, including wealth management, and it's got a commanding market presence in Quebec. So we think this is, if you're going to buy a bank, and you should because they're all cheap, this is the one to buy right now.
Your next idea, Granite Real Estate Investment Trust. What kind of property do they invest in?
Industrial property. This was started as a spin-off from Magna, owning the real estate under the Magna operations, but it's since expanded. Magna's selling at about 75% of net asset value of the real estate. And unlike most REITs...
Or Granite is selling.
Granite is, sorry, Granite. And unlike a lot of REITs, it's not very highly in debt. It's got debt equal to 30% of its net asset value, where most of the REITs run at 60 or 65%. So this gives it a lot of ammunition for takeovers and buying new buildings. And the industrial sector is the one part of the real estate world that continues to do well, unlike commercial buildings, of course, and shopping malls that are in big trouble. Industrial real estate is in high demand. So Granite pays a nice yield.
About 4.8%, I think. Yep.
Trading at, again, buying dollar bills for 75 cents, and lots of room to buy more real estate. Good operators.
Yeah, it's interesting, these giant data centers going up. I'm not sure if Granite is specifically in that, but we are seeing huge data centers being built and huge warehouses for e-shopping as well.
Yeah, warehouses in particular, yep.
It's changing the landscape, physical landscape, the internet. Copart, they're active in the U.S. auto sector. Can you remind us what they do?
This is probably a company that a lot of our viewers don't know. They're in the automobile salvage and auction business.
Oh, okay.
And one of the things that's happening is, as cars get more complex, when they get in accidents, they're being totaled rather than fixed. One of the reasons for this is the array of sensors and cameras that are on the average car now. They're very precisely aligned and set up. And if you get into what you think is a minor fender bender, the mechanic will say, well, I can't realign these sensors. And if I do align them and you get in another accident, somebody's going to sue me for not doing it right. And the insurance company says, well, we're just going to total the car.
That's interesting. Wow.
Yeah. So more car accidents are being written off as total losses. Some of the cars end up getting salvaged and sent to places where they don't need the sensors. Perhaps Africa or some places where the car is just used to get from here to there, and it may not tell you that you're going to run into a bicycle or something. So it's a duopoly, basically. And Copart has relationships with the insurance companies that decide what happens with cars that are damaged. So many of them are auctioned off for reuse. Many of them are salvaged for parts. One of the things we don't know is what's going to happen with electric cars. Much of the value in electric cars is in the battery pack. We think that the battery packs are mostly going to get reused. So cars will get in an accident, they'll total the car, they'll take the battery pack and resell it. So we think this is a growing market as cars get more complex, You know, you remember it used to be that small appliances in your house got fixed when they broke.
Yeah,
Forget that. Nobody fixes anything now. Well, cars are going to be like your toaster or your vacuum cleaner. Nobody's going to fix them anymore. As soon as it breaks, gets totaled and buy a new one. So great for Copart. Company trades at a reasonable valuation. Really, really well-run company. As I say, it's basically in a duopoly with one other company. And growing market for its services. So this is the kind of company we really like.
And it competes with RB Global, the former Ritchie brothers.
Yeah.
Because apparently there was speculation that Copart had been winning some vehicle business from RB Global.
Yeah, I think RB Global is much, much smaller in the automobile auction. I think RB is much bigger in yellow equipment, you know, big road stuff.
Right. Isn't that horrible? Disposable cars now. Yeah.
Well, you know, and think about it, what happens when autonomous cars come on the road. They're just going to be that much more complex, that many more systems. And again, people don't want the liability of putting them back on the road after they've been in an accident. So I think that this is going to be something that's going to be with us for quite a while.
First idea, as advertised, Meg Energy.
So I mentioned to, I think it was Daniel earlier in the show, about waiting for a top pick in the heavy oil space, and this is mine. This is a 110,000 BOE a day heavy oil producer, so we'll call it an intermediate. These are long life, low decline, very scalable assets, easily achievable to double this production base because of the size of the resource. We've owned this for a while now. It's been a very good performer, one of those highly leveraged names to any upside in oil, kind of like an Athabasca, but a much bigger company. It's a pure play, which is why we liked it. There's no dividend, but I do see greater visibility as they meet certain debt targets. I think their goal is to get to 600 million, and then they can increase their return of capital to something closer to 50%, maybe even 75%. And they'll probably do that primarily through buybacks rather than maybe the introduction of a dividend, because there isn't one. So this is one of those rare ones I'll talk about that does not have a base dividend like everything else I'd like to talk about on the show. But it is a very high quality asset. Might be, and it's always rumored to be, an M&A candidate for Suncor, because we know the base mine is coming towards an end, and how do they fill that gap? Obviously Fort Hills and the acquisition recently helps to fill some of it, but all that infrastructure, I think this asset would be prime, because it's 110, and I could easily see it in a larger company's hands over the next 10, 15 years, getting to 300, maybe even 400,000 barrels of production per day.
Okay. Sorry, where could you see it getting to?
I could see it tripling or quadrupling in terms of that asset-based production base.
This is Meg.
This is Meg.
Wow, I didn't know they were that big potentially. Yeah. Okay. Well, here's the company in the news, Tech Resources.
Geez, we can almost take an hour on this one. So I think I came on for a short segment several months ago when they were in the middle of this battle with Glencore, and were they going to be able to execute their own business plan of separating the met coal business and the base metals business run predominantly by copper, or whether Glencore is going to successfully acquire them. And neither one won because they were voted down on their proposed split, and Glencore obviously didn't win. They decided to go down the route of, well, maybe we'll sell the business, which is Elk Valley Resources. And they just announced a couple of days that they were going to sell it to Glencore. A little anticlimactic. I think if people always assume there's going to be about $8 billion US. They got $8.6 billion, and probably another billion on top from operating cash flow by the time it closes in the third quarter, they anticipate, of 2024. So kind of in line, but I think this takes a really big overhang off the stock. I know the stock doesn't seem to show that, and we talked off air about, the stock has been weak today in particular, and didn't show much enthusiasm yesterday compared to Glencore's stock being up, is I think the regulatory hurdles, perhaps the market is concerned. We talked about co-workers and the union asking the BC government to exert significant scrutiny on this transaction.
They're not thrilled about Glencore coming in and slashing and burning, maybe?
Well, look, I'm sure Glencore will say all the right things.
Yes.
I mean, it's not like they decided to enter into this in the last month.
No.
They've been working hard at this, and they have their own game plan of spinning out the coal assets as an entity within their organization. So they're going to say the right things. I'm sure they will appease everyone's concerns.
Yes.
Whether they act upon it over time, who knows, and what kind of strings you can put on this kind of a transaction. But for Teck on its own, as let's call it Teck Metals, which is what they're proposing the name change to be, I think this clears the hurdle, makes it a pure play on base metals, you know, the whole energy transition concept. And the copper outlook is great. QB2 is on track. I know capital has gone up a couple of times, but we could see the goalpost. So the sweet spot is this. They're going to be debt-free, probably $3 billion of cash in the bank, and QB2 will be in full stride by the end of 24 and in free cash flow mode. No new major initiatives for growth probably till 2026. So I kind of think late 24 and 25 will be a sweet spot in terms of return of capital to shareholders and operations really humming in terms of free cash flow.
Yeah, Jeffries, I think it was Jeffries said yesterday that there could be $5 billion in potential returns of capital ultimately.
Look, I look at this thing being probably a $70, $75 stock by early 2025.
I'm not sure if the viewers could hear. They're testing the emergency system there. I turned my smartphone off prior to the show. Denison Mines is your final idea. This would be one of your favorite uranium plays?
Yeah, this one's different. Look, we can always go buy a Cameco if you want the behemoth and the most leverage to uranium prices. But Denison is unique. We talked about E3 lithium earlier, about a new technology that has not been used outside of China. In the case of Denison, they are looking to use in situ recovery methods, which is used in the US, and it's used in Kazakhstan, for example, being the biggest producer of in situ recovery. So it's basically recovering uranium from underground using, again, chemicals and water to bring it up to ground rather than evaporating ponds like you see with lithium in South America. It's interesting because they've done a lot of technical work. I think it's largely de-risked. The technology is well proven globally. And I think this is one where they took an asset that wouldn't have been economic, even I'd say maybe at today's prices for uranium, using conventional technology. This has really brought down the capital requirements, probably $400 million to build this, $420 based on the last feasibility study. Operating costs would be around $16 a pound versus, you know, uranium's around $75 right now in terms of the term market. So very strong economics. The feasibility numbers showed, I think, a 90% IRR, which is quite impressive. So it is almost fully financed because the uranium they have in the ground or the uranium that they own in inventory plus cash, there's probably $50 million that they have to raise. So it's one of my favorite names in terms of leverage to uranium, and I think it's a prime takeout candidate.
Dennis, thank you very much indeed. Stan's first idea is Alphabet, aka Google.
Yes, we continue to own and like Alphabet. We expect about $284 billion in 2024 fiscal revenues. Parent company of Google, obviously the world's unrivaled leader in search and digital advertising. When you look at the Android OS operating system, it's still commanding over 70% market share in the smartphone market. YouTube, of course, continues to drive volumes with being the largest video sharing platform in the world. Cloud segment continues to be very strong. And Google's really determined to become a leader in the artificial intelligence space. And I have no doubt that they'll get there and get closer to being much stronger in the AI space. Hardware sales, whether it be Fitbits, Chromebooks, Pixel smartphones, and smart home devices, continue to diversify revenue streams. 50% of Alphabet's revenues are coming from international markets, so it gives you that diversified sort of stream of revenues. And really, Alphabet and Google is really poised to benefit from the post-pandemic rebound in digital ad spending. You're paying about 1.2 times PEG ratio, price earnings to growth, so that's very reasonable. The stock's been outpacing the S&P since late 2022. When you look at the share price, it's above a climbing 200-day and a climbing 200-week moving average. It recently beat analyst expectations on both revenue and earnings in its latest quarterly earnings. And we're seeing about an 18%, maybe 20% growth rate in earnings over the next few years. So we continue to like this name.
Okay, Alphabet gets the nod there. McKesson, the huge player in the U.S. pharma industry.
Yeah, so McKesson is a leading global pharmaceutical wholesaler engaged in the sourcing and distributing of branded, generic, and specialty pharmaceutical products to pharmacies, not to be confused with PBMs or pharmacy benefit managers. We're looking at about $305 billion in forecasted 2024 revenue. Their largest customers include CVS and Walmart. They basically operate in a virtual triopoly, sharing market share with Cardinal Health, which is a name we also own, and Cencora, which gives it very, very significant leverage in negotiating supplies and gives it very predictable cash flow. I think longer term, you have to see that with an aging population, that's going to increase volumes for spending volumes for prescription drugs. If you look in the U.S. today, almost 60% of all Americans use at least one prescription drug. That figure is expected to rise with an aging public or demographic. And also when you factor in the fast growing demand for diabetes and weight loss treatment drugs, those prescriptions are going to also drive the amount of volumes that are happening. McKesson recently announced a $6 billion share buyback program, so obviously friendly to shareholders. In the last quarterly earnings results, they beat analyst expectations on both the top and bottom lines, and also increased their earnings guidance for fiscal 2024. Looking at the chart from a technical perspective, the share price is above an ascending 200-day and an ascending 200-week moving average. So those are the types of charts you want to see when you want to look at things from a technical perspective. And the shares have been outperforming the broader S&P 500 index since about early 2019. And we're going to see steady growth, about 10% earnings growth from McKesson going forward.
Okay, and then your final idea, Novo Nordisk, a red-hot stock with this diabetes/weight loss drug.
Yeah, so this is a name that I've highlighted before, actually, I think in the last segment that we did together, Andy. It's a Denmark headquartered company. It's a leading global healthcare company, $40 billion in forecasted 2024 revenue, although that's always being ratcheted higher. It recently became Europe's most valuable listed company by market cap. It's clearly a global leader in diabetes and obesity treatment drugs, and they produce about half of the world's insulin supply. Over 36 million people around the world use Novo Nordisk drugs today. And we're certainly seeing soaring demand for key drugs like Wegovy, which is a weight loss drug, and Ozempic, which is a diabetes drug, treatment drug. When you take a look at Wegovy just last week, or earlier this week, Novo Nordisk reported some data that Wegovy actually is exhibiting some promising results in reducing major adverse cardiovascular events such as heart attacks and strokes. So that's another reason why we might see greater demand for these types of drugs. Management just recently raised its financial guidance, and now we're looking at about 38%, as high as 38% sales growth this year, and operating profit as high as 46% on the top end. Bank of America recently put out a report about the usage of obesity treatment medication users in the U.S. Today, there's about 1 million users. They forecast by 2030 that there's going to be 48 million users in that obesity treatment area. So names like Novo, names like Eli Lilly will do quite well. And technically, this share price for Novo looks very good. Its share price is above the 200-day moving average and the 200-week moving average. And the stock's been beating the S&P since early 2017. We're seeing about 25% earnings growth rate forecasted.
Stan, we better leave it there. Thank you very much indeed for joining us. First idea here, KAKAKU.com, a Japanese player in e-commerce. It's a price comparison site, among other things.
Right. So this is a company that I've mentioned in the past, and I hope that at the risk of sounding like a broken record, that there's some instruction and some lessons learned here for viewers, in that when we find a business that we like, and if it drops in price, again, due to short-term issues, we will double check our thesis and we'll increase our position, which we've done most recently in October at around 1,400 yen. So yes, they have Japanese's largest price comparison website. So if you want to buy a TV, you're not sure where to buy it or which TV to buy, you'll go onto their website and they'll give you, various retailers and prices, and you can compare various TVs and retailers where you want to buy that product. And they do that for a whole slew: washing machines, air conditioners, you name it. Coming through COVID, there was obviously a boost to that side of their business. And then coming out of COVID, there has been a temporary downturn, which has led to the opportunity. And we incidentally have owned KAKAKU since the middle of the pandemic 2020, when they dropped to around 1,700 yen and we initiated the position. They also own Japanese's largest restaurant review and more recently reservation website called Tabelog. So think Yelp and OpenTable combined. They have a lot of restaurants under contract, approximately 70,000. They have approximately 90 million monthly users on this website. It's a very, very strong business for them. Of course, websites are asset light. But for the development and ongoing R&D, there's not a lot of cost to maintain these websites. And then they've got an emerging third pillar, which is Kujin Box, which is a jobs classifieds website. So great company. They have strong returns on capital, pay a dividend, and buy back shares.
We're getting a bit tight for time here. Kaspi is a Kazakhstan-based e-commerce company that does a broad range of things.
They are a super app. So think Amazon, PayPal, grocery delivery, pay your taxes, renew your driver's license, all on one app. 75% of the adult population of Kazakhstan use Kaspi, and they use it on average 2 times a day. So their engagement is world-class, next level. This is approximately our 12th largest position in Hillside Co, with just shy of a 3% weight, because it is in Kazakhstan. So there is obviously geopolitical risk there. I don't pretend to understand the country or the dynamics of the geopolitics of the region. I'm not an expert, but this is a very, very well-run company. They trade at about 10 times earnings. Dividend yield is strong. We're showing 1.8% there, but it's actually quite a bit higher than that at about 5%. And they're also actively buying back shares. And they are founder-run, founder-owned. So again, this is a company I've featured in the past. We were able to add to them most recently in the $40 range when there was the riots in Kazakhstan in early 2022. So very, very strong company, but I would urge viewers to do their own due diligence and to size the position fairly small given the geopolitical risk of the region.
And then finally, you referred to this one earlier, Calnex, listed in London, a player in telecom equipment.
Right. So again, this is a company that I've featured in the past, and I've spoken about them. We did some research on them. At the time, they were too expensive. We had our fair value estimate at just a shade over £1. And they most recently have had a significant downturn in the stock price, not necessarily in the business, but in the stock price, because they are a fairly small company. So they sell testing equipment mostly to telecommunications companies. And right now we're in a CapEx downturn for these types of businesses. So think Verizon, Bell, et cetera, their CapEx cycle is in a bit of a lull. This is the third time that Calnex has experienced this in their history, most recently in 2014. All times in the past, they've been able to recover and go on to increase their earnings. We most recently added to our position at 95 pence, 67 pence, and 41 pence. We've taken this to approximately a 1.5% weight. So because it is a small company, because it is relatively newly public, and because it is AIM listed in the UK, we would also urge viewers to size any position they would enter into this company accordingly. But it is founder-run, founder-owned, no debt, and has a really, really strong culture. And again, this is the type of company that we want to own for our clients for decades, and we think we'll do very well with it.
So you're in the Buffett school. Your favorite holding period is forever?
Yes, absolutely. Again, once you have a compounder, you want them to be able to compound your capital, ideally forever. I'll say decades. Forever might be a bit of a stretch, but yes, if you've got a company that is increasing shareholder wealth predictably and sustainably, you buy it and you just hold it and let the compounding do its magic.
Okay, well, we better take a break. Jason, it was great talking to you, and thank you very much indeed.
Thanks so much. Good to see you, Andy.